The Great Depression ended almost a century ago, but the forces that created it remain active. Bubbles form, banks weaken, and credit dries up. When investors sell in unison and households pull back, they create a defensive loop. If enough of these individual choices reinforce one another, an ordinary downturn can turn into something much darker. This inquiry examines systemic fragility rather than predicting a specific doom for 2026. While the modern economy features different institutions and advanced technology, the underlying question remains: why does a system designed for stability occasionally fail to absorb a shock? The 1929 stock market crash often serves as the shorthand for the decade-long collapse, yet a market break alone rarely causes a 10-year depression. In October 1929, stock prices fell violently and fortunes vanished on paper, but the disaster reached historic proportions because the surrounding system was too fragile to hold. Today, the Federal Reserve stability reports highlight high regulatory capital and resilient large banks. However, those same reports identify rising leverage in hedge funds and vulnerabilities in private credit, modern areas of stress that could interact with a sudden shock. We are looking for the chain of events that turns a bad day on Wall Street into a systemic rupture. A crash is a trigger. It damages confidence and wealth, but economies frequently survive market breaks without descending into mass unemployment. The Great Depression represents the moment the system stopped absorbing shocks and started amplifying them. The 1920s boom arrived with a sense of invincibility. Automobiles, radios, and electric appliances entered homes as advertising expanded desire and assembly lines increased output. For millions, the future seemed to be arriving ahead of schedule. This prosperity hid deep pockets of instability. Farmers struggled. Rural banks leaned on weak agricultural income, and wages lagged behind productivity. To bridge the gap, consumer demand increasingly relied on installment credit, and investors bought stocks on borrowed money. Credit serves as confidence made practical. It pulls the future into the present, assuming tomorrow will always be good enough to pay for what today has already claimed. When that assumption breaks, credit becomes a trap. The 1929 shock traveled a specific path, from stocks to banks, from banks to credit, and from credit to money. It continued through prices, debt, and eventually unemployment. The final link in this chain was fear, which fed directly back into the financial system to restart the cycle. Economic danger frequently appears as strength moving too fast. That rapid movement sets the trap for any era. Deflation served as the engine that turned the 1930s downturn into a disaster. As demand, money, and credit shrank together, prices fell and business revenues collapsed. Firms cut wages or jobs, which further reduced spending. However, the mortgages, farm loans, and business debts remained fixed. As incomes fell, the real weight of that debt became mathematically heavier, forcing people to sell assets into a falling market. This debt deflation cycle ensured that the more people tried to pay their debts, the harder those debts became to pay. By the early 1930s, the thousands of small local banks across the United States became the primary points of failure. Without federal deposit insurance, a bank failure meant the total loss of savings. In this environment, withdrawing money was a rational act of self-protection. Banking relies on collective trust. Because banks lend out the majority of their deposits, they cannot satisfy every depositor at once. A single person's caution becomes another person's warning, until a line outside the building becomes evidence of a collapse. Panic becomes failure, and failure creates more panic. These forces, speculation, leverage, liquidity risk, and herd behavior, are living ingredients of financial life. When a crisis begins, investors sell, banks tighten lending, and businesses stop investing. Each individual acts to protect themselves, and in doing so, they collectively freeze the economy. The Great Depression was a psychological event that became mechanical. Fear changed behavior, behavior changed balance sheets, and those balance sheets confirmed the initial fear. This is the psychological trap. The moment individual prudence becomes collective contraction. Modern institutions are built to interrupt this cycle. Deposit insurance, central bank liquidity, and rigorous stress tests for large banks provide a layer of protection that did not exist in 1929. The Federal Reserve now monitors capital levels and funding risks to ensure the banking sector remains sound, even under severe recession scenarios. These defenses have changed the nature of a run. Retail depositors no longer need to stand in physical lines to protect their savings. In the 2026 stress tests, the largest banks remained above their capital requirements, even when facing massive declines in real estate and employment. Vulnerability has migrated toward leverage and asset valuations. When prices rise far above historical norms, the system becomes sensitive to any disappointment. Leverage allows institutions to hold massive positions, but forces them to sell the moment prices drop, or lenders demand collateral. Modern panic travels through digital payment channels and repo markets at electronic speed. A fund facing redemption requests or a lender refusing to roll over financing can trigger a liquidity crisis in seconds. The physical bank line of the 1930s has been replaced by a network of digital transfers. Current systemic risks often reside in less visible areas: hedge fund leverage, derivatives, and private credit vehicles. Private credit has grown into a massive source of financing for riskier firms, yet it remains largely untested by a severe, prolonged downturn. If the crisis migrates, a problem starting in private credit or tech valuations can quickly become a banking problem, then a money problem, and finally an employment problem. History warns that we should not confuse the invisibility of these modern channels with safety. The modern parts of finance are faster and more complex conduits for the same self-protecting panic seen a century ago. When regulation tightens in one area, risk grows in another. The system adapts to safety rules, and risk learns to root around them. History serves as a pattern detector for systemic vulnerabilities. It teaches us to look for chains of events rather than single explosive dates. A modern crisis would likely begin with a sequence of quiet, small reversals. Early warning signs arrive as localized losses and subtle shifts in lender confidence. An expensive market correction can force leveraged investors to sell, pushing prices lower for everyone else. These sales create further losses, prompting lenders to demand more collateral and thinning out market liquidity. This stress eventually reaches the credit markets. Lenders become selective, refinancing becomes expensive, and firms that relied on easy borrowing find themselves with no room for error. When businesses delay hiring and preserve cash to protect themselves, they inadvertently weaken the broader economy. One company's caution becomes another company's lost revenue, eventually reaching households through layoffs or reduced hours. These events, a cooling economy, a tightening credit market, and cautious consumers, are different angles of a single interconnected process. By the time every part of the system is visibly weak, each part is actively weakening the others. The second decision, the collective choice people and businesses make immediately after an initial shock, serves as the true psychological climax of a crisis. Policymakers must interpret these shocks in real time. Acting too slowly allows a panic to become self-confirming, while acting too broadly creates new distortions. Modern crisis management remains a challenge of acting decisively before the evidence of a panic is fully visible. Human instincts remain unchanged. We still chase returns in good times, underestimate rare disasters, and discover hidden leverage only when prices fall. We still protect ourselves in ways that can harm the whole. Confidence functions as the invisible infrastructure of the economy. When it breaks, every transaction becomes conditional. The Great Depression showed how easily trust can evaporate, turning individual prudence into a collective collapse. A depression is a social process. It is the result of millions preparing for worse times in ways that ensure those times arrive. While 1929 is unlikely to repeat in its exact form, the forces of speculation, leverage, and fragile confidence remain. The ultimate challenge is recognizing the next chain of self-protection before it becomes an unstoppable machine.